Welcome back to another episode of Taking Inventory. This week, we're welcomed by Turner Novak, founder of Banana Capital, a Twitter legend with over 160,000 followers, kind of a meme generator, and also the host of the Peel podcast, the Split newsletter, just staying on brand with Banana. Turner, super excited to have you on the podcast today. Welcome.
Thank you. Thanks for having me. Excited to be here.
Thanks, man. Yeah, we appreciate you making the time. I guess before we kind of get into kind of how you got to here, but just kind of curious, I guess two things. One is, what is the origin story of Banana Capital? And then I know that you're based in Michigan. Just for listeners, maybe if they haven't heard your other podcast, just love to kind of just share more about your background and kind of like how you got to where you are today.
Yeah, that's a big question. So the starting Banana, I guess just growing up, I always thought I wanted to start an investment firm. Coming up with a name, Banana Capital. I don't know if you guys ever tried to name a company, but basically everything's taken. So my wife was like, hey, Apple's the most valuable company in the world. What about a fruit? And I was like, yeah, that's pretty good. Like there's not that many that are taken. So, and I thought banana was it was a single word, which I thought was important. You can convey it with an emoji, which I also thought was important. It's kind of serious, but it's also kind of funny. It's one word, like Sequoia, Snapchat, benchmark, A16Z, whatever. It's very bold, I felt like it could stand out and, slot alongside everyone else. And I also just thought it was hilarious to have a fund called Banana Capital. It kind of seems like a joke, which, I don't know. I've always leaned into memes for kind of top of funnel marketing. So I just kind of felt on brand. So that's the context on Banana. I invest in pre-seed and seed round. So I usually try to be a pretty early investor. Most people would say I'm consumer focused, pretty general. I'm just trying to find people building cool stuff, solving really hard problems that you can have a business model attached to and could maybe be a publicly traded company one day. I feel like that's kind of the point of venture. I don't try to, follow certain theses or themes. I just try to, usually the stuff I invest in looks kind of weird. It's kind of like one of those things where you're like, wow, it's kind of strange, but maybe that could work. That's kind of the sweet spot about what I try to hit. Generally software, but open to a little bit of the more trickier areas. So yeah, it's kind of super high level.
Before starting Banana Capital, you were at a few other funds, but I think most people, if they know you well, it's because they follow you on Twitter and then subsequently have read your newsletter and listened to your podcast. But curious what that Twitter experience was like, because you've grown such a big audience. It seems like that was the jumping off point for Banana Cap. And so what has that story been like to just grow that audience and have some fun with it?
Yeah, it was basically I was trying to get a job in VC. This was 7 years ago, I think, at this point, or something like that. And I just kind of thought, wow, they're on Twitter. I might as well start tweeting, right? I think the term creator and audience wasn't even a thing. I was basically just trying to share my thoughts and kind of have these public timestamps of, making statements basically. There are those things where you're like, I'll probably be right over a long enough time horizon. And I kind of was treating it like a VC in the sense of they're a little bit out there. Some of I think when you guys first maybe started following me, I was tweeting a lot about Snapchat. It was after the IPO. I think it was Kendall or Kylie Jenner came out and had that tweet. It was I don't use Snapchat anymore. The stock had tanked. And I remember Snap did the big redesign and everyone was like, this is terrible. This is a disaster. It's going to go bankrupt. And I was like, honestly, I think the complete opposite. It added a bunch of ad inventory to the app, which I thought was a huge thing that no one was talking about. The business model is basically Facebook's business model, which is one of the best business models in the world. Just in a lot of the product changes that were being made in the redesign, I was like, I actually think this is probably net overall going to be good over the long term. And yeah, people were just like, this is the craziest thing I've ever heard, but interesting thoughts. I remember when Musical.ly rebranded as TikTok, that first day when the news article came out about it, I was like, kind of weird, but started using it. I was like, holy shit, this is the best app I've ever used. And again, I just kind of started tweeting about it because I thought it was weird. No one else was talking about it. And then the more I dug into it, it was like, wow, it's owned by this big Chinese company. They have this, it's basically the Facebook news feed of China, tons of cash flow that's generating. They just raised like $3 billion. Looks like they're plowing it into US user acquisition. I'm like, there's no way that this doesn't work. Again, maybe like exaggerating a little bit, but I just try to find stuff like that was just kind of interesting. I thought people would, want to hear a different take on. And again, this is a long time ago at this point, but that's kind of how I initially got started on Twitter and just sharing thoughts. It was things that I felt really strongly about that I probably had like some kind of unique insight on, just kind of sharing my point of view, and then, crossing my fingers I was right in a couple of years.
And in terms of you starting to write like angel checks and then ultimately having the fund, did that come from that? Were you like, because you're based in Michigan, and like my assumption is that you started getting this big following, and then it was like, oh, I have like pretty interesting access, like maybe I should take advantage of that. Was that sort of how it evolved?
I mean, kind of. I think the probably like the best practice on getting into investing is, you just kind of start using extra money to invest in friends' companies and stuff. I didn't really have extra money. I mean, I think at any point in time I had like a couple grand in my bank account. I've used I didn't really grow up with a lot of money, never had a job that paid a ton, living in Michigan, paid off student loans, all that stuff right after I graduated. So yeah, I did this kind of fantasy VC portfolio. It's like fantasy football or fantasy sports, but for VC. I pretended I had $1 million, fake invested in the companies, wrote like a memo on each one. And honestly, I had no idea what I was doing. Looking back, like it wasn't that good, but it was just good to, learn slowly learn what I was doing. And then a long process, but use it to get a bunch of interviews to eventually get jobs at different funds. And then again, a little bit of a long process, but it was essentially Twitter and just like, people that were following me on the internet that wanted to invest in my fund when I did it a couple of years after that. So,
and that's most of your LPs. Are most of your LPs like individuals, or you raise money institutions as well?
It's a little bit of both. I mean, like the bulk of the, I think I have like total across my funds, maybe 200 LPs, there's 136 in the first one and then 77 in the second one. Most of the line items on the spreadsheet are individuals, but a couple like larger checks from more institutional. So yeah, the first one was kind of the end of 2020, Q1 of 2021. And then the second one I raised Q2, 3, and 4 of 2022. It was kind of a long process. I don't know if you guys raised money in 2022, but would not recommend. I would not go back and do it again.
We went through it. It was not super fun. Good experience, but not super fun. Yeah.
Yeah. I mean, it's not supposed to be easy to raise money, but it was like it was way too easy leading up to it. And then it's gotten a little better now. But I mean, 2022 was like literally, it was like the end of the world, basically. It was impossible.
And how many investments have you made out of that most recent fund?
Most recent fund, I believe 24, 25. Wow. My first fund I did it a bit more. My strategy was a little bit different. So first fund, it wasn't spray and pray, but it was pretty diversified. Like each check was like 1 to 3% of the fund size. I just got advice from a mentor that I really look up to. He was like, you're going to mess this up. So do not have a concentrated portfolio. Make sure you take a lot of shots on goal and just change your strategy as you go. And I just resonated with that the most. So first fund was pretty diversified, and I made a bunch of dumb decisions, a couple good ones. And then the second fund was a little bit more concentrated. And then going forward, it's again a little bit more concentrated. I just think if you're going to do early stage venture, you have to be in like the top 10% of funds. Otherwise, your investors are probably going to make more money just investing in, public markets, just index funds. And one of the tricks to outperforming, I think, and as an investor, is to be concentrated in your best ideas. And I think venture's super risky, so you should be as diversified as you can, but you do need some concentration. So I generally like to do, I think 20 to 30 is probably the sweet spot. Fewer portfolio companies than that, you just run the risk of not taking enough shots to get lucky, and you just, you have nothing that works. And then more diversified than that, I just feel like you just kind of run the risk of not capturing as much of the upside of like when you're right. There's different ways to do it, but my philosophy is try to be semi-concentrated, and it's just me, and I like to kind of try to be able to help as I can. So I just don't want to have hundreds of portfolio companies and just, not being able to be responsive, semi, very lightly hands-on, I would describe it as.
And so what is your process? I mean, you opened up by saying, like, you don't have a really narrow thesis. You're kind of broad. You've got some consumer, you've got some SaaS. So what is that process to evaluate companies of every industry and then decide to put capital behind it?
Yeah, I mean, it's pretty fluid. I mean, because I'm investing so early, I would say it's generally founder first, and then, I guess two ways to think about it. Like, some people say you really want to be team focused. Some people say you really want to be market focused. I think a lot about the market, but it's still kind of founder and team first. So there's certain areas I'm just kind of not interested in. I don't do a lot of ad tech investing. I don't know if you guys if that's a good thing or a bad thing to be on this podcast. I just don't know anything about it. I think it's kind of a tricky market. Crypto, I've just never really done. I just don't really get it. And then in terms of like team and stuff, it's like, it's the same thing as everyone else. Do I think as founders in like the top, 0.1% of ambition, intelligence, knowledge of the market? Do they really understand their customers? It depends on the stage, right? Like, if you're investing before the product's even been created, it's like, can they build something? And then as you go further down kind of the stack, or as they get a little bit later, it's like, can they hire people? Can they sell this multiple times? Can they, create new products to layer on top of that? What is, like, does my spreadsheet have more new line items, like new revenue lines other people don't know about, as you get more into growth stage and public markets? But yeah, since I'm investing so early, it's like a lot of emphasis on just the founders and do I like the general market, kind of broadly speaking.
And do you feel like being in Michigan has been like a competitive advantage just because you're kind of away from the like echo chambers of these sort of coastal markets?
Yeah, there's pros and cons to it. I think it just kind of lets me be a little bit kind of divorced from some of the craziness. I mean, I definitely miss out on stuff for sure, but I do travel a decent amount. Just try to, spend a lot of face time with people. But yeah, just like I live with my in-laws, my kids, and then my wife's grandma also lives with us. So it's like just the average American. I just kind of think about it as like, you might be surrounded by people in San Francisco and New York, and it seems like there's a lot of buzz about something. But then when you kind of go, as this company might be, quote unquote, raising their Series A or B or C, or like, the customers they'll be reaching when they have 10 million customers, I can kind of always surrounded by those kind of people. It's a college town, so there's still a lot of early adopters here on a lot of stuff. So yeah, that's kind of I think there's some advantages, but there's definitely disadvantages. You're just so outside of some of the hubs. It can kind of be inconvenient sometimes traveling and stuff, but it's what makes me different, I guess.
Okay. So you live with this big family, you've got kids, you're the only person doing the investing. You've got 2 funds, you've got a super active Twitter account. So you weren't busy enough. So then you decided to start a podcast and a newsletter. What was the idea behind that, and like kind of how has that played into, I guess, this general thesis of like Turner as like a media company and investment firm?
Yeah, it actually took me a really long time to figure this out, because like for the longest time I was just like, I want to be an investor. Like, I don't want to be an influencer. Like it just kind of slowly happened, and it kind of was forced on me. So I'm like, all right, I just gotta It's the thing that I've uniquely figured. I just got to lean into it. So it's probably like 2 years ago, started a newsletter, tried to write more consistently, longer form. About a year ago, started a podcast. Every week, put out an episode, try to help founders tell their stories, get really in the weeds of, the nitty gritty of the early days, share lessons with other founders. And then people wanted to start sponsoring it. So I'm like, cool, like it helps pay for the cost of putting this thing together, which is, with smaller funds, like there's management fees, but not a ton. So it's kind of like, all right, this is, I kind of like started developing this thesis where it's like, all right, so I kind of have a media company that kind of like all lends towards the venture fund. So I can when you think about the operating budget of running a investment firm, I have money coming from the media side. So like typically just broadly speaking, when you have a VC firm, you collect about 2% of the fund size in fees every year. But I kind of have this like extra bonus money kind of coming in too that I can use that also benefits the fund. So I'm like, it's kind of cool, I guess. Like in theory, I'm giving like my LPs a bigger kind of bang for their buck. Like there's more money going to work on the operating budget than if I didn't have revenue from the media stuff. And it all just benefits the fund. Like I just basically build it all up to help friends, portfolio companies, etc. So yeah, it was all kind of an accident, but I'm just kind of like, all right, everyone's got to take advantage of what, like their position in life and what's going on. So I try to lean into it as much as I can.
And for some of your podcast guests have been awesome. I mean, you've had like some pretty amazing guests. I listened to the Julius.ai one. That kid's awesome. It's hysterical.
Yeah,
but have you?
amazing.
Yeah, I didn't connect that he was the Twitter guy when Elon came in. That's amazing. But has that helped a bunch with deal flow? And are you investing in a lot of the companies that you were interviewing?
Not investing in a ton of them, just because a lot of them, like a couple publicly traded company founders that have been on like a decent amount of like slightly later-ish stage, right? Like they're doing tens or hundreds of millions in revenue, and I'm usually trying to invest, before they really start the company. That's like ideally try to invest as early as possible. So I have a couple portfolio company founders that have come on, right? Like they've gotten a little bit further along and it's like, okay, let's do your first ever podcast episode. Like you'll come on my podcast, you kind of build up some distribution to kind of just help them get the word out there. But ideally, I mean, that's the plan. If you look forward like 5 years, it's, as founders kind of graduate, get ready to start doing these things, you kind of have like, all right, we'll do your first podcast episode. It'll be highly edited. You can't mess up. Like we'll make sure that you don't say something dumb on the pod, and just get like a good story out there that you can kind of use as like marketing collateral.
And yeah, I mean, I've listened to a few too. You have some great interviews, and it kind of fits your Banana Capital. You talking to AI companies, SaaS companies. I listen to Athletic Brewing. You're kind of just having interesting conversations, regardless of industry. But I imagine it also gives you a pretty good perspective on just like the state of early stage as people go through, or as companies go through growth, to late stage. So maybe can you give us like a sense of where we currently are in the cycle from your perspective, and like what is the state of maybe that early stage market?
Yeah, I'm trying to think of where we are in the cycle. I think it like early stage is always a little bit different than just the rest of the capital markets, because it's like people always have ideas to start companies. Sometimes there's more or less capital available, and sometimes there's more or less like, founders willing to take risks, or individuals, entrepreneurs willing to take risks, where we are in like technology cycles, right? And like mobile, AI, PC, internet, whatever, if you go back over the last couple decades. I think one of the biggest things that we've kind of worked through over the last couple of years, just generally with VC funding, like if you want to raise venture capital for your startup, I think a lot of people think of the VCs, but it actually really starts with the LPs, the limited partners, like the massive institutional capital that's giving money to the VCs. So, if somebody tells you like I have this $100 million venture capital fund, it's not all their money most of the time, right? They got to go to these massive pools of capital, like a pension plan. Like we'll just say like the New York firefighters department pension plan. I have no idea how big it is. I don't even know if it's a thing, but if it is, it's probably like a 10, 20, 30, $50 billion pool of capital, and they're trying to get returns, right? And typically with a pension plan, you are paying out money every year, quarter, month, whatever, it's your pension constituents, and it's kind of guaranteed. If they worked if they're a teacher, firefighter, whatever, they have all these promises, we give you this fixed pension income. So they have these targets that they have to hit in order to be able to pay out that money to their kind of beneficiaries. So what they're doing is they're taking all the capital, they're investing it in different assets that will give them, income and a return stream that kind of matches what's due. Yeah, so generally with one of these big institutional portfolios, you have a bunch of these different asset classes that kind of all work together, and you're making commitments to all of them. So it's just kind of at a super rough level. Let's say you have, no one would actually do this, but just to make it super simple, let's say you have 50% of your portfolio in public equities like the S&P 500, and then you have 50% in venture capital. There's maybe a couple that actually do this, but they're probably in rough shape right now if they did. So what happened kind of over the last, I don't know, just say decade, VC returns were really high. It was like a asset class that people, you see it keep going up. So generally the way humans behave, when you see one of those charts that go up, you assume it'll keep going. So you put more money into it. And so the way that that most venture capital firms work and the way these LPs work is they don't commit money and then give it all to you up front. They like plan it out over a couple years ahead of time. And they're usually like, they have their own cash flow requirements that they're kind of constructing their portfolio to hit, of like when they're going to be receiving money from their investments, when they're going to be going out. So they kind of do all this planning. Generally, it's a couple years ahead of time. So when you're talking about it's the year 2020, it's the year 2021, things are looking really good. You're committing all this capital to these funds that meanwhile are usually about 3 years that they get deployed over. Those deployment periods got pretty short, just over the past decade, from 3 to 2 years, from 2 to 1. I think there's like a couple public articles talking about some really big funds that deployed in like 6 months in 2021. So it's an LP that's really institutional portfolio that's planning all these things perfectly to a T. People are speeding up on you. Your valuations are really high, in theory. Meanwhile, you kind of have this whole portfolio balanced. It's 2021. The market starts to come down. Your public portfolio, instead of being 50-50 weighted, your public portfolio will just make this extreme. It gets cut in half. So now your public markets are 25% of your portfolio and your VC's 75%. You're suddenly saying, okay, hold on. We want this to be even. We need to stop making VC investments. And by the way, they're probably all overvalued too. So we really have no idea what our portfolio is actually worth. We are not doing any new VC investments, and for the time being. Like a lot of people kind of paused. So that was kind of what happened in 2022. People are just like, we don't know what anything's worth. We need to get this all sorted out. Meanwhile, you have VCs are still like trying to make investments. You, as an LP that has this very kind of finely tuned portfolio, you're kind of like trying to fly and land this plane, managing all these cash flow needs. There's a lot of different moving parts. So come 2023, markets kind of came back a little bit. But a lot of VCs, the way that they're thinking is they're like, okay, I need to invest my portfolio in a way that kind of makes sense for my LPs. Like I was kind of matching my cadence to what they wanted. So what you kind of saw if you were raising money as a founder in 2021, the way that you make money as a VC is you collect that 2% management fee on the total amount that you raise. And if it's pretty easy to raise your next fund, you're probably going to try to do whatever you can to raise that next fund faster because it means you make more money, right? That's your business. Generally for VCs, their business is collecting management fees, not making money for their investors. So in 2021, you're actually incentivized to just continue to invest faster and raise more money. Meanwhile, in 2022, 2023, you're just less likely to make those investments and put money out the door because that it's not as likely as you'll raise the next fund. So it's kind of influenced how VCs have thought about their own portfolio and how they make their investments because they just don't know if they'll be able to raise their next fund. So it's kind of this like trickle down thing where you can blame it on whatever you want, but it's really like at a super macro level set from like the very top of the capital markets. It's just there's less liquidity and it's harder to move money basically. Really, at the end of the day, VCs are like middlemen between the founders and the ultimate source of capital. So that's generally how I like kind of frame all this stuff. There's a lot of moving parts. It's really just set by like the willingness of the capital allocators to give money to VCs is really what drives how fast and how much they're investing, which then obviously it's the founders.
And I guess given all that, like, I guess in that sort of kind of repricing sort of phase, like, do you feel like we're at this point now where the capital is starting to come easier to investors? And, I guess if we see rate cuts, Like, and like, if I don't know, I guess by that equation of like the portfolio construction, it's like, do you want the public markets just sort of ripping for you guys? Would that be a good thing for you? So you can go and where are we? And like, what is your mentality with all that? And are you watching that? Are you looking at the public markets? Or are you just like focused on your portfolio?
Yeah, I mean, I kind of pay attention to it as much as you can, because I think there's just a meme of like, great companies are founded at any point in time, right? Like, doesn't matter if we're at the top of the bubble, bottom of the bubble, right? Like, things are still getting founded. Most VCs will tell you, valuations sort of pulled back last year or in 2022. So most VCs will probably tell you, right? Like, valuations are lower. We should be deploying a bunch of capital. That's like what VCs will pitch to their LPs when they're trying to raise money. I think, another thing that we kind of have to work through is just there's so many startups that have raised so much money. A lot of portfolios are still kind of underwater or in not exactly the best position. A lot of valuations on a lot of startups are still probably like on paper a lot higher than what they truly should be. I mean, we probably won't get through it until like 25 or 26, just like fully through it, right? Like, it still might be another 2 years. Because, generally most startups raise about 2 years of capital, plus or minus a year. So if you just think probably Q2 of 22 is when it got hard, and we're about 2 years from that. You can obviously do layoffs to extend your runway. People are raising extension rounds on its same valuations that they raised before on like, weird terms that kind of mask, how exactly the businesses are doing. So that's kind of happening too. I think it's kind of one of those things where it doesn't just like solve itself. You just kind of slowly work through it. Like, I know companies that have 6 years of runway on the balance sheet of cash and don't have a product, and they're valued at a lot higher than they would be if they actually try to raise money today. It's just kind of a reality. So it's just kind of one of those things. I think it slowly works itself out. I think another super interesting piece of all this, I know I think we're kind of talking about mostly early stage. Those valuations didn't really go down a whole lot. I think they've actually increased since 2021, I believe, if I'm just remembering the data. So that's not really a good thing if I'm an LP like looking to allocate to the asset class, right? And I think kind of the issue is just you had all these big funds that were traditionally investing a little bit later on, where it was, in theory, there were more mature businesses and just the valuations were higher. They were deploying like a $50 million check into a Series C round. Those kind of didn't make sense for a while, because you might be able to say, I want to buy stock in Snapchat in the public markets, and it's, they're doing $4 billion in revenue, and I can buy it for an $8 billion market cap. It's like 2 times revenue or 3 times revenue, 80% gross profits or something. Like, it's a pretty good business. I think if you like minus Snap's like hardware spend and just like other, MISC categories, they have pretty good margins. So
yeah, selling digital air is a very good business. Yeah.
You guys know it's digital ads are like one of the greatest products ever. But then when you go and you say like, all right, I want to invest in this, like, I don't know, some private company at like 82 times revenue in the Series C or whatever, you're like, this is ridiculous. I'd just rather buy public markets. Or what you could do is you could say, all right, well, I have like this buddy from business school. He wants to raise like $5 million for like some AI thing. Like, that's a way better deal than investing 50. Like, I'll give him 5. Like, you're deploying 10% of the capital, but you're still kind of doing something. So I think that's kind of a function of what happened over the last couple of years, in the sense of some of these later stage valuations came down pretty significantly, whereas early stage really didn't. Because like, I bet if you guys went out and were like, hey, we're starting a new company, we've kind of done it a couple times, we want to raise a couple $1 million, like, people would probably give it to you versus, the universe of people who've never done it before. So fewer founders are raising money, but like the most consensus ones that kind of clear the market, right? Like, it's a thing with like private markets. It's like something doesn't get priced unless a deal actually gets done, versus public markets. It's kind of like, whatever, right? Like, there's always going to be a buyer for some public stock at 1 times revenue or whatever. So I think that's another thing. Just like early stage valuations have been kind of in a weird spot.
And for those prices, right now, we have a bunch of friends that have left Snap recently to start companies. There's probably some more like on the way. Like, what does that look like? Are those term sheets? Is the post 20? Is the post 10? Like, what is sort of like the entry for a consensus early stage company?
I mean, they're honestly kind of all over the place. I generally think what you do is you just figure out what's 2 years of runway and then 20% dilution. That's like I think that's generally the starting point, but then there's a ton of nuance to that. So, I mean, I guess just like working through the exercise, you might be like, all right, there's three founders. We want to hire a designer and engineer, 5 employees. We need like, I don't know, it's like $100K a month. Maybe there's like some MISC expenses. So we want like $3 million. We don't want to sell more than 20% of the company. So like roughly that gets you to 12 million post. But let's say you previously sold your company to Snapchat and gave your investors a 10x return. You could probably say, we want to do this at 20 instead of 12. Or let's say you already have a product that's live and you have some customers. You might be able to say, all right, we want to do it at 15. Or maybe you have a product and customers and you've done this before and that gets you to 25. Or maybe you've, never, this is your first startup ever. It's an unsexy category no one's ever heard of before. You're like, I don't know, you're making like notebooks on the blockchain or something. Like, I don't know, just like something that no one cares about, right? So usually there's like a supply and demand thing. So like if the clearing price is basically like the valuation of the company. So if just no one's interested, your valuation, your clearing price will kind of come down lower. So yeah, I think like just the function of having like a product in the market, having done it before, team experience, like relevant insights into the market, like all that stuff will kind of, I guess, increase your valuation. But I don't know, at the end of the day, I mean, I think really the only thing people can kind of tangibly talk about publicly or like brag about is like how much money they raised or what the valuation was. And like that doesn't always lead to success, right? So I think it can kind of sometimes get you down the wrong road, being focused on your valuation or how much you raised when it might not matter, right? Like really at the end of the day, it's like we're helping our customers. We built a real company. Those are just like harder things to measure. So I just think sometimes it leads to like maybe some suboptimal decisions, if that makes sense. I don't know if you guys have thoughts on that, but.
No, I think it's tough because more recently I feel like a lot of my friends who started companies, they basically have kind of, I think, come to that conclusion that like the price doesn't matter. They just don't want to have asshole investors and they want to have control. Just a bit enough like kind of horror stories. So I think people are starting to understand that, and I think that maybe is leading to better incentives. I don't think that was the case in 20 or whatever, like I know people that were raising money at like, it was like 50, like for like a seed round. It was like, what is happening here? It was just wild.
Yeah. I mean, the tricky part is, I guess if people aren't familiar with what liquidation preferences are, typically when you raise beyond a seed, I mean, sometimes in seed too, but generally when you're raising from VCs, there's this thing called a liquidation preference where you basically, usually it's 1x. You just guarantee if there's a liquidity event, they will get paid back what they invested before you get any money. So if we just use a really extreme example here, let's say you're a fintech company, multiples in fintech got insane during the high. Like they're down like 90% in some cases for some of these companies. So let's say your company, let's say you raise $1 billion at a $10 billion valuation, and then just the multiple that people are value your company is down 90%. So now your company's worth $1 billion at a 10 billion. You've raised $1 billion and your investors have a 1x lick pref and your company's worth $1 billion. So basically there's nothing beyond that. Like you get nothing as the founder. This is a very extreme case you probably won't run into in the early stages, but it's an interesting example of like just getting a little bit too far ahead of your skis can kind of mess up your cap table. And then it's hard to hire people. Like let's say you want to hire this super talented person. They want a couple $1 million in equity, but it's not worth anything. So you can't give it to them. Like the equity's worth nothing really. So you have to like recap the company. There's ways to do that, but it sucks. No one likes doing it, but it's like the only way through it. And that's basically you just wipe everyone's value of their existing shares to almost zero, which is, again, not fun. So, and then there's other cases of like, let's say you raise some money at like a 10 million valuation. It's easy to get investors excited about the upside from going from like 10 million to whatever. But let's say you raise your last round at 100 million and you're trying to raise some more money. Like if there's not enough there to like substantiate a $100 million valuation, it's harder to get people excited. You know, do you have new people come in at a lower valuation? Some of your existing investors won't like that. There's just different incentives that people have. So, I mean, it can be great to talk about how high your valuation is sometimes, but it can also come back to hurt you. I mean, we're definitely seeing it right now.
Yeah, and it sounds like this is obviously from experience and seeing markets kind of develop, and you seeing the trajectory of a lot of your companies going from pre-seed, seed to maybe some of these challenges and some of the kind of exciting growth that they're getting. But reading some of your stuff, I'm curious. You're so focused with Banana Capital on the pre-seed, seed, but you do a lot of writing and interviews of late stage, pre-IPO, even public companies. We've talked a lot about your analysis of Snap. You've talked about Temu, a handful of other companies. And so is that more of like a passion for you? Do you use that as a way to then inform how you think about the earlier stage companies? Like, how do you think about investing in early stage, but then analyzing big company? And for anyone listening, I think you also were an accounting major, if my research was right. And so I imagine that plays into a lot of the analysis too, which is kind of fun, actually, even just hearing you talk about your analysis. Like it is very analytical, financially analytical, which is cool.
Yeah, I mean, to start, I hate accounting. I think I'm not that good at it. I think like accounting is the language of business, right? So if you want to run a business, have a business, you should at least kind of understand it. I mean, I grew up on the internet as a kid, so I was like, I don't really think I need to take classes on understanding, how to do marketing. Personally, that's my opinion, but it was like, man, I suck at accounting. I need to understand this stuff. I should probably just figure it out. And I don't think I'll just kind of figure it out for fun. Like I should probably take some classes on it. That was basically my thinking. And then, I think like if you're a founder, like what do you kind of look up to? You probably look up to people who've built like real companies, like real businesses. Like that's probably like the most exciting thing to hear about. Like I love reading about just early stories of like, Snapchat or NVIDIA or insert whatever company. Like it's kind of cool just to learn what people who have kind of made it all the way through, like what it was like for them. I just feel like it's definitely relatable. And then there's also like the social proof and the branding on it. Like this founder has made it, like here's their story, versus somebody, they might be still kind of figuring it out and they're kind of bullshitting you and they don't really know it. I kind of like to lean more towards like, this is like a proven, they've kind of done it story. That's generally why. And then I feel like it's good to just learn how businesses work. I think it's good to learn what's actually going on like in the market. So that's kind of why I write about more tangible stuff. And then like for my own portfolio companies, like a lot of time they're like, hey, don't talk about this, right? Like they don't want people to mention stuff. So it can kind of be, you kind of pull on other threads.
And then just before we let you go, I think I mentioned earlier, like, I feel like you were always ahead of the curve on Snap. You called Temu. What is sort of the next thing out there that that you're thinking about? And this could be, I think, more like kind of on like the public markets or kind of not for your own portfolio, but like what's another thing that you're like, man, this could be big and would age. It's a prediction that would age well and over the next few years.
Man, I don't even know, to be honest. It's a lot of pressure. I mean, I guess, I think the healthcare system in the U.S. is kind of a giant scam. So, like, it's if you just like think about it, about 20% of your paycheck, really, at the end of the day, you don't even see this if you're an employee. It goes to your health insurance, basically, and the whole healthcare is like 20% of U.S. GDP. I think it's 18 technically. And again, it's all kind of a scam. So like it doesn't actually prevent you from getting sick. Like the whole system is basically just set up to just get us sick and milk money from us until we die, really. I think it's going to break. I don't know how, but I've kind of invested in a couple things related to that. I think housing in this country is also insane, like so expensive. And part of it is just like a supply issue. Like we just need to build more housing. One thing I think is interesting is just this trend of living close to and next to people that you actually care about and like. Like, so for me, it's like the family. Like we live with a bunch of family members. It's a really normal thing outside the U.S. We just don't really do it here. It's basically like a white U.S. people kind of thing. Like it's a very like small percentage of the total population, but it's like this, it's very like, it's like suburban mindset or whatever that we have in the U.S. We're very like singular. So I don't know if it's like a return to more communal living. And again, like, I don't know how the heck that plays out. I just think it's kind of going to happen. I don't think this is really a hot take anymore, but I've always been like pretty bullish on Threads from Facebook. Like it's kind of whatever it is, but it's Facebook. They'll make it work. They got existing distribution. I think I saw they actually have more DAUs than Twitter does in the US, which is, it's like surprising and not surprising. So I don't know. I just have always thought it's going to work, basically. It's kind of one of those, like, again, it's like one of those things people in tech maybe don't really follow it, but trying to think of anything else that's interesting for people. Those are probably some big ones. I don't know how hot those are.
If anyone wants the next few, they got to follow you on Twitter or subscribe.
Yeah.
That's it.
Healthcare and housing, those are pretty big. The TAM is pretty big there. So I think that's a good sector.
Well, I think another super interesting is just like the solvency of cities. Like the whole business model of like city, local governments is just like issuing debt, doing infrastructure projects, pushing things out, extending like like if you think of like the budget of a city is basically just like the tax revenue from the people that live there. Cities are shrinking, tons of debt on these infrastructure projects, and interest rates are going up, and infrastructure is kind of expiring, and we're going to have to redo them. And that kind of ties in this whole like housing thing. It's just like, I do not know what's going to happen. I just don't think it's going to be good. And I don't even know if it's like actionable from a venture perspective. I'm just like, cities going bankrupt is like something I think we're going to see a lot of over the next decade. And like the water system in this country is like all the pipes have lead in it, and like no one talks about it. All our food has like plastics and stuff like that. And it's like, I don't know how you fix this, but I think it's a pretty big deal. It's like, hopefully someone does something. Yeah. I'm interested, like as an investor, like adjacent, if there's, startup ways of solving it, I'm always interested in talking to people. Education, again, like it's kind of a similar thing with cities. Like a lot of the school system is like set infrastructure. People are leaving the schools, whether it's moving away to different cities, homeschooling, private schooling, etc. I think the schools are going to kind of be in an interesting spot with just like not being able to fund budgets, and like as the dollars going in get smaller, students leave, I think the issues will kind of compound and get worse. So again, I don't know how it plays out, but it'll probably be some big changes over the next 10 years. So
yeah, I mean,
these are all, I guess I'm talking my book too. I'm like, I have investments related to these, but also looking for more. So if people are interested, those are some of the crazy ideas that I have.
These are big existential things too. So it's like, my mind just keeps going. You need a bigger fund 3, it sounds like, to start funding some of these projects.
Yeah. I always like joke around. People are like, what's your like end goal? It's like, I don't know, like with the Flint water crisis, right? Like remember that was a big thing. It'd be cool to just like fix it. Right? Yeah. You'd be like, oh, cool. I have like, here's like $100 million. Like, let's just fix it.
Yeah.
I don't know what that looks like, but maybe that's my goal in life. Yeah.
Let's get some people that actually do something. Yeah.
Yeah.
No, Turner, this was a ton of fun. I feel like we covered everything, and we just covered even more at the end. So, people interested in learning more about you, following you on Twitter, Banana Cap, newsletter, podcast, where can they find you in all these different places?
Yeah, I probably am the most active on Twitter. It's just my name, twitter.com or x.com/Turner Novak. And then there's links for my podcast and newsletter. The newsletter at this point is basically just transcripts from the podcast. I don't think I've written anything in like 8 months, but if you like that, they kind of coincide. The website for my fund, I haven't updated in like 3 years, but it's bananacapital.vc. Probably should update it. But yeah, that's the best ways to find me.
Okay, great. We'll put those in the show notes. And no, really, really appreciate you hopping on with us today.
Yeah, this was a lot of fun. Thanks for having me.
Thanks, man. We appreciate it.